What are the 7 best dividend stocks to buy and hold forever this year? It is wise to educate yourself about dividend stocks and why they can make excellent investments if you're new to this industry. Once you understand how dividends operate, a few essential factors can assist you in finding outstanding dividend stocks for your portfolio, such as payout ratio, history of raises, steady revenue and earnings growth, durable competitive advantages, and high yield. Even when the market isn't healthy for most equities, the greatest investment plans prioritize passive income for long-term tax-paying investors. Long-term gains from investing portfolios that incorporate dependable dividend equities may be attainable. Furthermore, the capacity of a company to consistently pay a dividend and boost payouts year after year shows that it has a strong balance sheet and earns higher earnings than enterprises that do not pay dividends. Here are the 7 forever dividend stocks you should check out. Number 7. Costco Wholesale Corporation, ticker COST. Consumers can be fickle, especially over time, but Costco has resisted the normal volatility of retailers by cultivating an extremely loyal and valuable client base. The Kirkland product cult is real, with blogs and social media pages dedicated to these best products under this Costco store brand. And the retailer consistently scores near the top in terms of customer satisfaction. In terms of money, the Cost boasted more than $1 billion in membership fees in its fiscal first quarter, which concluded in November 2022. You know you're onto something when you can make $1 billion in 90 days without selling a single product. With a strong brand due to high-quality discretionary items and low-cost household essentials and solid baseline demand. Even in the age of e-commerce and changing tastes, this is one retailer that is here to stay. Number 6. Johnson & Johnson, ticker J&J. There are 3 compelling reasons to buy Johnson & Johnson at this moment. To begin with, the stock is defying the bear market, indicating that investors see potential in J&J. The other 2 reasons are that J&J believes in dividend growth and that the company will experience major change in the coming year. Let's start with the dividend. J&J is the king of dividends. That implies it has grown its dividend every year for the past 50 years. This is wonderful news for shareholders since it demonstrates that payout growth is vital to J&J, implying that the company will likely stick to its dividend policy. J&J now pays an annual dividend of $4.52 for a 2.57 return. According to the New York University Stern School of Business, this is a greater yield than the 2.07% approximate average for the pharmaceutical business. Consider the significant change coming up this year. J&J is spinning off its consumer health division into an organization called Kenvue. This is good news because consumer health is J&J's smallest revenue generator and has the slowest growth of the 3 industries. That leaves J&J with the more profitable pharmaceutical and medical technology companies. In the most recent quarter, revenue for these entities increased by 9.2% and 8.1% respectively. J&J is currently trading at less than 20 times forward profit projections. This appears to be a realistic valuation given the dividend increases and the new era of earnings growth that lies ahead. Number 5. ABBV Incorporated, ticker ABBV. Spun out of parent company Abbott Laboratories, ABT in 2013, ABBV obtained branded biopharmaceutical products in order to establish its own route away from the stead and lower margin sector of all medical equipment and consumer health products. ABBV has more than tripled since then, outperforming the remaining ABT business. AbbVie has worked hard to keep its product pipeline full of profitable medications, such as the Freestyle Libre glucose monitor for type 2 diabetic patients, which is expected to generate $4 billion in sales this year. Several industry magazines forecast that AbbVie will surpass all other competitors to become the largest pharmaceutical business in the next 5 years, owing to a good outlook. With recession-proof medicine sales and unparalleled size, it is difficult to fathom a world without AbbVie. Number 4. The Home Depot Incorporated, ticker HD. Home Depot Incorporated is a consumer goods firm that sells home improvement products. In its retail outlets around the United States, the company sells things like building materials and lawn and garden products. It is based in Atlanta, Georgia. As of October 31st, analyst Steve Zacconi has a buy rating on Home Depot Incorporated shares. The analyst also set a price target of $340 on the shares. For the past 12 years, Home Depot Incorporated has increased its dividend, making it a reliable dividend-producing company for income investors. In the current market situation, the company's management team has also performed well, increasing profits and revenues. Home Depot Incorporated reported revenue of $82.7 billion in the first half of 2022, a 5.2% increase over revenue in 2021. During this time, the company's comparable sales increased by 4.1%. In the second quarter, 75 hedge funds were long Home Depot Incorporated, up from 68 hedge funds in the previous quarter. Their respective stake values were $5.6 billion and $6.1 billion. As of November 2022, HD's dividend yield was 2.57%. Number 3. The Coca-Cola Company, ticker KO. The Coca-Cola Company is a consumer staples company that provides non-alcoholic beverages all over the world. It is located in Atlanta, Georgia. Peter Graham of UBS reiterated a buy rating on Coca-Cola Company shares in October 2022. The analyst also boosted his price target on the company from $63 to $68. Coca-Cola is one of the top dividend payers today, having regularly increased its dividend for the past 60 years. It reported an 11% increase in revenue for the third quarter, including a 4% increase in concentrate sales. Because the company is also a defensive stock and is in the consumer staples sector, it is regarded as a great pick during times of inflation. Out of 895 hedge funds tracked in the second quarter, 64 funds were along the Coca-Cola Company. Their total stake value was $29.2 billion. Coke's dividend yield as of November 2022 was 2.94%. Number 2. Mobil Corporation, ticker XOM. Mobil Corporation, situated in Irving, Texas, is another energy company on our list. It explores for and produces crude oil and natural gas in the United States and around the world. As of October 2022, Truist's Neil Dingman has a hold rating on Mobil Corporation shares. In addition, the analyst boosted his price estimate for the stock from $111 to $114. Mobil Corporation has piqued the interest of investors since reporting third-quarter sales of $112 billion and operating profits of $25 billion. Because of its dividend and strong performance, most investors regard the company as a growth and safety bet, hedging against geopolitical instability and energy problems. Exxon is a dividend aristocrat, having increased its dividend for the past 25 years. Exxon's dividend yield as of November was 3.18%. Number 1. Devon Energy Corporation, ticker DVN. Citigroup analyst Stock Gruber restated a buy recommendation on Devon Energy Corporation shares on October 21st. In addition, the analyst boosted his price estimate for the company from $77 to $80. Devon Energy Corporation hopes to benefit from higher energy prices by increasing natural gas and oil production in the United States. In the second quarter, the corporation also hiked its dividend by 22% to a record high of 1.55 cents per share. It has increased its dividends for 4 years in a row. In the second quarter, 66 hedge funds were long Devon Energy Corporation, according to our data. Their overall stake was worth $1.9 billion. Devon Energy's dividend yield was 6.02% in November 2022. These companies are safe bets that are set to thrive in the tough economic factors anticipated in 2023 and beyond. Analysts believe that now is the ideal moment to acquire a large number of these stocks. Always do your research before any investments in any of these forever dividend stocks. Did you find this video helpful and informative? Please let us know in the comment section below. Please support us by showing your appreciation for this video and give us a big thumbs up. And subscribe to our channel. If you want to be notified when we release a new video, click on the notification bell to be up to date on everything related to crypto and finance. That is it for today's video. This has been Diversified Streams. Thanks for tuning in, and see you in our next video.